This session will cover principle of investments and the different asset classes to understand the potential benefits along with correlated risk. Coming up. Some of the major asset classes on the investment risk ranking are cash, bonds, mutual funds, and ETFs. Let's start with cash. A cash bank deposit is the simplest investment asset and the safest, but whatever interest you would earn is highly unlikely to be greater than the inflation. Certificate of deposit, also known as CDs, are similar to cash, typically provide higher interest rate than savings accounts, but money is tied up for extended period of time, maybe even 5 years. And if you want to withdraw early, you would be penalized. Next one is bond. One-liner, folks. Loan made by an investor to a borrower. Simple example of bonds would be bonds issued by the US government with the fixed interest rate. So they can use your capital to finance operations and other projects. Projects like infrastructure projects, for example, right? What about stocks? When you buy stocks, you own piece of the company, and it would benefit you two ways: when the price of stock increases and through dividends. Being a shareholder of common stocks, you have voting rights, but there's a caveat. Preferred stockholder get preference over common shareholders in terms of dividend payments. However, they don't have voting rights. Next one is mutual funds. Multiple investors pool their money together in order to purchase securities. You can invest in mutual funds for as little as $1,000 per share, which would allow you to diversify into as many as 100 different stocks contained within a specific portfolio. ETFs, similar to mutual funds, but they trade throughout the day on a stock exchange. In this way, they are similar to stocks because you can buy and sell throughout the day. This also means their value can change drastically during the course of a trading day. Due to the ease of trading and bonds coverage, ETFs are extremely popular with investors. Before we take a deeper dive, make sure to like and subscribe, hit the bell icon so you can get notifications as soon as I put more contents. Let's look at the alternate investments. There are three major classes. You can buy real estate by directly buying a commercial or residential properties. Alternatively, you could purchase shares in a real estate investment trust, also known as REITs. Similar to mutual funds, basically. They trade like stocks on the same exchange. I have another video where I covered in greater details, so check out the investment playlist on my channel. Second is hedge funds and private equity funds. Money invested in hedge funds is a part of a variety of assets aimed to deliver more than average market returns. But performance is not definite. Incredible shifts in returns are observed on a regular basis. Sometimes disappointing returns by a significant margin compared to regular market. They are available to certified investors only and usually requires high initial investment of $1 million or more. Third one is commodities. It refers to tangible resources like gold, silver, crude oil, and agriculture products. Combination of these asset classes would help you to diversify your portfolios. You can start with simple investments, then gradually expand your portfolios. Specifically, mutual funds or ETFs are a smart first step before moving on to individual stocks, real estate, and other alternative investments. To avoid anxiety about monitoring your portfolios on a daily basis, stick to index funds that mirror the market because it would be a viable solution for you. Word of advice: consult with independent financial advisors who get paid only for their time instead of those who collect commissions. Beware of biased opinion. Most people look for passive investing options, but there are benefits of active investing as well. The goal of active investment is to beat the stock market's average returns and take full advantage of short-term price fluctuation. It requires deeper analysis and the expertise to know when to buy or sell stocks or bonds or any other asset. Passive investment, on the other hand, requires a buy and hold approach, which means resisting the temptation to react to stock market volatility. Oh my God, this stock has jumped 50%. I could have made a lot of money in a single day. Sound similar? I know. Passive investment approach is to buy an index fund that follows S&P 500 or Dow Jones. Successful passive investors keep their eye on the price and ignore short-term setbacks. Let's look at the pros and cons of active versus passive investing strategies. Some of the key benefits of passive investing are lower fee. You do not have to pick stocks, so it makes life simpler because oversight is minimal, so it's less expensive. Passive funds simply follow the index they use as their benchmark. Number 2 is transparency factor. You would have clear idea which assets are in your index fund. And the third one is tax efficiency. Their buy and hold strategy does not typically result in massive capital gains. Of course, tax for the year. Let's take a quick look at the drawbacks of passive investments. Limited investment holdings. Passive funds are limited to specific index with very limited variations. So you are locked into those holdings, no matter what happens in the stock market. Typically have smaller returns. It's highly unlikely that being a passive investor, you will beat the market because your core holdings would be locked into track the market. Once in a blue moon, you may beat the market by a little, but it would never be bigger than the active investor's desire. Now the active investing. Advantages are flexibility. It does not have to follow a specific index. You can get into unique opportunities from stocks perspective. Hedging. You can hedge your bets using various techniques like short sales or put options and exit when the risk becomes too big. Next one is tax management. To offset the taxes on the big wins, you can sell some of those investments that are losing money by tailoring tax management strategies. Shortcomings of active investments are very expensive. Fees are higher because all that active buying and selling triggers transaction costs. Since your fund managers would do research on equity picks, all those fees over decades of investing impact returns. Active risk. Your fund managers are free to buy any investment they think would bring high returns, which is great when they're right, but terrible when they're wrong. So the million-dollar question here is, which of these strategies make investors more money? While passive investment still dominates overall due to lower fee, active investors are willing to put up with the fund managers, even with the higher fees, to leverage their expertise for guidance due to market volatility. Combination of both active and passive investing over time for major milestones like retirement would be more helpful. More and more financial advisors are using combination of both strategies. All in all, active investing requires a hands-on approach, typically by a portfolio manager, while passive investing involves less buying and selling by using index funds or other mutual funds. Check out my book on Amazon, a must-buy for smart investing. This book covers common beginner's mistake and 15 tips to avoid major losses, along with key areas related to capitalizing on short-term, medium-term, and long-term investment. Down below in the comment section, let me know which one you prefer, active or passive investing, or maybe a combination of both strategies. Thank you for listening in, and I'll see you tomorrow. Thank you.